Well, we're coming off the back of a bruising week for risk assets. Certainly, crypto was taken downtown to Chinatown and carved up pretty closely. But we're seeing a bottom coming in. Will it's last? Obviously, that's something we're focused on. The AI trade has got called into question, but we're seeing a a bifurcation of what's going on with stocks leveraged to AI, OpenAI under pressure, and then those stocks leveraged to Google and their developments in AI finding the love at the moment. So that's an interesting theme that we focus on. We saw the Nasdaq go down into a nearly 10% drawdown, but it's since rallied, and we're finding buyers very much prevalent as Alphabet finds the love, and we're seeing banks ripping as well as healthcare stocks. Can this last? A lot of focus on the Fed cutting rates in December, but how influential will a 25 basis point cut potentially be? Will it actually happen? We focus on all these factors and more in today's trade-off. Well, hi traders, I'm Chris Weston, Head of Research here at Pepperstone, and we're joined in 2 seconds by Blake Morrow from Forex Analytics. And as always, we will be discussing the setups, the trades that we like, the directional views, the news, and dissecting where the skew of risk is in this market. Mr. Blake Morrow, my good sir, would you come into the program? How are you?
I'm doing great. It's Thanksgiving week here in the United States, and I just want to say I'm thankful to you,
Yeah.
thankful to the Pepperstone staff, and I want to say especially thankful to our viewers for watching us each and every week and sticking by our sides.
Yeah, no, it's obviously it's the show's developed and evolved, and you're a major part of that, and you obviously give some fantastic contributions and views, and
Thank
a
you.
lot of the time you're right. Sometimes we're wrong, and sometimes you're right. But I like to think you get more right than wrong. Anyway, look, what is the Morrow family up to for Thanksgiving? Have you got all your turkey and all your bits and pieces sorted out?
Yeah, we're spending the day before with family. My son, he's going to be in. We're going to play a little golf. Then on Thanksgiving, we're going to eat a lot of turkey, Mediterranean style, with probably about 20 family members. And then
Oh,
the
wow.
day after, we're going to do our own turkey, non-Mediterranean style, so we can have some more leftovers at our house. So I'll be a good 5 to 7 pounds heavier when I see you next week.
Oh, sure you won't show it, mate. But that sounds amazing. That sounds exactly what it's all about. And I love the concept of Thanksgiving. Christmas obviously is something that goes on big in the Western household. But I love the idea of giving thanks and being appreciative of the good things that you got. So I hope it goes well, mate. Sounds like you're doing it properly, and I wish I was there, obviously. But let's go into topical thunder and let's focus on the markets and see what's going on. Right. So I'd say the risk reversal, specifically in equities. Now, what we saw last week was people blaming the Fed pricing, and we saw a fairly hawkish set of minutes, and the rescheduling of the non-farm payrolls and the CPI data till past the FOMC meeting means that the ability for us to price correctly the whether we get a December rate cut from the Fed was called into question. And that's what we focused on, the respective views from each Fed member who spoke. And I think we've now come to a point where you can pretty much look at the 12 voting committee and say, well, what is their view? They've been fairly definitive, except J-Pow. And we've got like a 7-5 split in my view, we've got a 7-5 split in favor of a rate cut. And that's why the market's probably pricing 92% or just a little bit lower than that, 86% chance for a rate cut now. For me, what's more important for the US dollar is the terminal pricing and where the market implies the Fed could go down to. That's dropped below 3%. It's not alarming levels, but I think it's below 3% and it's finding buyers. So obviously the implied yield is going down. But people have said that. Obviously, there's big concerns around the AI return on investment, GPU depreciation, and what that means for the earnings. There seems to be a bifurcation, as I say, between the stocks that are leveraged to Google and those towards OpenAI. OpenAI is being called into question because of the amount of funding they're going to need, whether they can truly monetize their 800 million subscribers. You name it. There was a big drawdown in risk, but it seems to have snapped back now. You've seen big leadership from banks. Healthcare is absolutely going bananas at the moment in the S&P, and Alphabet as well is showing absolute leadership. And Meta, I think, is looking quite tasty as well from the long side. So how are you seeing risk here? From a lot of these sort of high beta assets, and where do you see the skew of directional situation?
Well, first of all, going back to your comments regarding like AI and these LLM models, the Chat GPT and I mean, there's a lot of competition out there, and
Yeah.
Gemini is getting a lot of sway, obviously with Chrome, and that's why Google's doing really well, and people are very impressed with this, Gemini that you can use for free.
Yeah.
So there's a lot of competition in the space.
And Claude
That's
as well. Claude, I mean, Gemini and Claude.
yes, yeah, Claude, yeah.
You compare them to ChatGPT, and I know we're going to get ChatGPT 5 coming out fairly soon, which is going to have to step up because so many people are saying, well, when they come to monetize this, and sorry for stealing some of your time, but yeah, when they
No,
come to monetize this in the future, you know, they've got 800 million users. People will say, well, do I really want to pay premium rates to stop the advertising when I can use these alternatives, which are already somewhat better? So I think that's an interesting one. So keep
that
going.
is it is, but I want to just really quick. I want to highlight that Nvidia, post earnings, and Nvidia is actually trading a little bit lower and isn't technically, without showing you the chart, it's broken below some support, and it hasn't broken below 165, which is kind of like my line in the sand, but it
Mm,
doesn't look good. So technically it's not looking great despite this bounce back in risk. We also stalled at the 618 retracement of the entire from all-time highs in the S&P to the lows from last week. We've screamed up to the 618 percent retracement. And then if you look at the leader that really led equity markets lower is crypto. And if you look at Bitcoin, you look at Ethereum, their bounces are very shallow and not very convincing. And I'm going to show you some of those charts a little bit later. So to answer your question, am I convinced? Are we heading back to all-time highs here? I'm very skeptical of this
mm.
move.
I will say,
So
just I know we're going to move on, and we will, but I think it's an important point that Nvidia has got $100 billion investment in OpenAI. Broadcom, AMD have as well. And so those stocks have been underperforming the broader market, and I think that's an interesting concept that the stocks that are leveraged and interconnected with OpenAI, Oracle, and Softbank are obviously ones as well. Softbank is something I'll focus on, and I think should be front and center. But then the stocks focused and doing deals with Google, maybe Apple to an extent, they're holding up. Meta, they're holding up, and they look like they might close the gap. And there's other stocks as well. So I think those stocks that are leveraged towards the Gemini side, I think are outperforming. Those stocks, making investments in OpenAI are underperforming, and I think that's something that is really evolving.
and make sure you all stick around for the remainder of the show because Chris is going to be bringing you some of those charts, which I
Yeah,
think are very, very under the radar right now. But
okay.
I want to talk about something that was front and center today, and this is regarding the FOMC. We are waiting for our next FOMC chair to be announced, and it was just today that we are expected an announcement by December 25th, so by Christmas, the Christmas holiday. But the name that's floating at the top right now is Kevin Hassett. Now, Kevin Hassett, I want to talk a little bit about this just because he was an economic advisor to the late John McCain, to President George Bush Jr. He's also known as a Trump loyalist and a yes man, and I do think that his name floating up to the top was a little bit of a litmus test today for the markets, and we saw the markets respond accordingly. We saw the dollar weaken. We saw equities take another surge higher. They were sitting near highs, and then they made a new high as his name was announced. And I think it's rather important to note because if you think about what Trump is doing here, if he puts in Hassett, and Hassett ends up being his man, if you will, his next FOMC chair. Is Fed Chair Powell going to stick around? And then you got Lisa Cook that's going to be removed more than likely.
Yeah.
So you got two vacancies. So you got a Fed that's really going to be stacked with very dovish FOMC members. I know the FOMC is comprised of a bunch of different governors and it takes a vote, but you have the leader, potentially Hassett. Then you have a couple open seats, which will be filled by maybe Moran, maybe other doves out there, people that are going to fit the agenda that President Trump wants to see. Now, I know it's going to usher in all sorts of more issues in the future. We can talk about that, at a later date. But what do you make of this whole Kevin Hassett situation? And do you think it's going to have as big of effect as I do if he is announced as the Fed chair?
Well, I was saying, I think I said on the show a couple of months ago, I think he would probably get the gig. I'm not trying to pat myself on the back, but I think obviously he was one of three, so it's not. I've had a 33% chance effectively, but his odds now on Polymarket have gone above 50%. So the market is saying, and I think it's interesting to see that equities rallied on that speculation, even though he was always seen as a front runner, and the dollar came off. So maybe that equity rally is testament to the market saying that we give Kevin Hassett a stamp of approval. But I think from a dollar perspective, I was chatting to Michael Brown about this, and he said, "Why would anyone sell the US dollar on this?" Well, I think for me, it comes back to the Fed independence, the political the independence trade, and therefore you have a higher political premium priced into the US dollar because, if you've got a guy who is, the market will sound this out. Is he just a slave to Trump? Because Trump's biggest influence he can have on the Fed is choosing the Fed chair. That's ultimately the biggest influence he can have every so often when it comes about. And so he will make sure that person is completely in his pocket, or at least, and therefore, if Kevin Hassett get the job, he will need to win the respect of the markets to prove that he is not a political puppet and not just carrying out Trump's work. And when he gets that independence, and I think he'll make sure that he really stamps that out, that he is not, he is completely independent. And I think that's where we'll search out at the beginning is how much of a slave to Trump is he going to be? And I think that's an interesting reaction. Maybe it was a troll balloon just to see the market reaction, and maybe he won't get the gig. I think that would be an interesting concept. But at the moment, we could be surprised. But I think an announcement will come pretty soon. But he's got to corral the other 11 voting members as well. So it's not just going to be his view.
Sure.
One interesting thing, and we can move on quickly, is this idea about what kind of Fed president is he going to be? Is he going to be someone a bit more like Greenspan, who is more I'm the man, I'm the sort of the leader, what I say counts, or is he going to be someone a bit more like Bernanke or Yellen, who is very much everyone can speak, everyone's got free speech, So what kind of president is he going to be? Is he going to be someone who puts weight on other people? Is he going to be the man and really sort of take control? So I think that's going to be something that we'll explore very, very closely as well. So an interesting one, but certainly, I think it goes into the next topic about Fed cuts, because I think we look to the 10th of December for the Fed meeting, and look, the market has now swung from 35% implied probability last week after the dovish, the hawkish Fed minutes and the rescheduling of the data to about an 87% chance now implied in swaps pricing, which is almost a lock, given that we don't really have a huge amount of data to tier one data until that Fed meeting. We could be at the mercy of Nick Timira's article in the Wall Street Journal or something like that. But the market's saying we're pretty close to a lock. A Fed cut is done. But what does that mean? Do we sell dollars on it? We could get a hawkish cut. It's the idea that we're cutting now, but we might not cut again. There's already a huge dispersion amongst views amongst the Fed. So maybe this is this could come with a hawkish cut, which could actually ironically see the US dollar trade higher. How are you seeing this?
I see it the exact same way. I think that the worst thing that could happen to the market is that we get a hawkish cut. And your question is, does the Fed cut matter in December? And the answer, in my opinion, is it absolutely does, because if they pause in December, it's more unlikely for the Fed to cut, pause, cut again, pause. Once they pause, this is probably going to be a cycle pause, which might last a couple of meetings. And so I think it does matter. And if they do cut and it's hawkish, meaning there's going to be searching for information after the government shutdown, waiting for the inflation data,
Mm.
waiting for the the more jobs report, more data to come in. I think that's going to be. I agree with you. I think it's ironically, or what's the right term I'm looking for? It would probably allow for the market to actually rally. The dollar would rally and stocks would
Mm.
actually fall.
I think that's the perverse nature
Reverse.
of
That's it.
is you read on the textbooks when you start currency trading that the rate cuts are um, mean that there's going to be a weaker move in the currency, but yeah, when it's priced in, what's more important is I think why it's important for a rate cut here is because we've got this anticipation of the policy path goes down to 3% by late next year, early 2027, and anything that muddies that water and says we're going to get there more slowly, there might, if we might see a period of hold that allows us to get to 3% at a slower rate. I think that's where the market will de-risk and sell off. So I think anything that opens the door to get us to 3%, which I say is the terminal pricing of where the market anticipates the Fed rate to go to a low point. Anything that gets us to that point quicker and smoother is music. It means that our pricing for that terminal right is seen as a more of a higher conviction, should we say? So I think anything that muddies the water and prolongs that is a negative for risk.
I agree. And Chris, I'm gonna keep this next segment short. I obviously want your opinions here because they obviously matter a lot to our viewers. But over the next couple of days, we're running into what is going to be kind of tricky. Tomorrow, being middle of the week, we have a lot of end of month,
Flows.
corporate end of month flows that are hitting the market. But you see that the last day of the month actually happens on Sundays. So that means a lot of orders are going to get done Thursday and Friday. And Thursday, obviously, the US markets are closed. So, in observance of Thanksgiving, but that doesn't mean like currency markets are closed and European markets and Australian markets and Asian markets are closed. Everybody's open, but liquidity is going to be a little bit less because you have one of the major players that happens to be out on holiday, and then on Friday we have only a half day here in the United States. So liquidity is going to be poor, and we're running out of time for orders to get done, flows to get done. So between end of month flows, end of quarter, or end of month flows, corporate month end flows that should be hitting the market tomorrow, and data set that's getting shoved into a couple of days here in North America. It's going to be a busy couple of days, and it could be very illiquid and very jumpy. And so the point I want to make here is, as Pepperstone being the broker, or a broker that we all hope that you guys trade through, it's great when you do a lot of trading, but also what Chris and my job is, in my opinion, is always about longevity, to making sure that you guys as traders stick
Absolutely.
around as long as possible, make as much money as possible. You're always around, you're watching our show for the next 10, 15, 20 years, whatever the case may be. We want longevity. And one of the things that I get most fearful about for you and for traders in general is periods of illiquidity. And that's what we're going to be dealing with over the next couple of days during these holidays. So please trade with caution, bring down your size, your position size. And I call it target trading. Figure out where you want to be involved in the market and be involved at those levels and only those levels. Be very specific about where you want to be trading versus chasing the market. Chris, I didn't mean to
no, it's fine. I think
yeah.
I don't want to stop you because what you're
No,
saying
please.
is absolutely is gold. I mean, and you bring up a really important point, and it was a major factor last week. I mean, we saw top of book liquidity in all asset classes coming in really thin, and that's why we saw more exacerbated moves. Banks were talking, of flow desks and banks were saying that top of book liquidity and market and depth at touch was much more reduced than what we'd normally see, and that's why orders a big order that comes in on the sell side, it comes in, bang, takes out the bid, and it works its way down the order book. If it can't get filled at the top of book, it obviously works its way down. And obviously, if the thinner that market that volume is at touch price to take, the more you can move the market. And that's why we do see higher volatility regimes, and liquidity is absolutely thematic of that. So, yeah, you've got to be open-minded to whippy rides, reversals that can happen on a dime, and more exasperated moves. So, yeah, liquidity is the oxygen in markets' lungs. That's system liquidity, but yeah, actual depth of book, I think, it will thin out, and that's what leads to higher volatility. So, absolutely, I think you bring up a great point. So, yeah, we saw it last week, and it's part of the reason why we saw big moves play out, and it will be very much thematic over the Thanksgiving period. So, obviously, when in the art of managing risk, this is something that we all need to be aware of. So, do take that into consideration. And Blake, I think you nailed it on the head. So, thanks for bringing it up. Great chat. Anyway, let's go to that's the setup. All right, what we got? US 500. Let's have a look, because we've just been chatting about the intricacies of the market. Now, actually, the index of choice, which I should have brought up, is actually the Russell 2000, which is screaming along. I went along some KRE regional banks, not because I like the fundamentals of regional banks. Obviously, they come with risk; they're a higher bank. But yeah, if you go and have a look at the technical setup, and the market is liking what it sees, and therefore I'm just piggybacking off what the market sees and what they, where the probabilities skew. So, yeah, with the Russell, that there's a large component of financials and regional banks that make up the Russell. So I think, despite what we've seen in the data flow with consumer confidence weakening, retail sales under a bit of pressure, the small caps are outperforming, and I think that's probably where it will continue to be so. But if you can look at the technical chart of the S&P, we've had 3 up days now. We've seen short-term moving averages obviously follow what we've seen in the price. So that's a positive in itself. We held the swing low from October, which I think was a lot of people were setting as their risk barometer, and guiding stops on longs. I think we've seen a lot of shorts covering in this run up now. Healthcare is showing absolute leadership. It's screaming. Alphabet the market's got an absolute love affair with Alphabet at the moment. It's all-time highs. Tesla's looking okay, but Meta is also now starting to work and looking to close the gap. And I think we will see a period of outperformance there. So, do I like it higher? I think so. I think there's upside momentum. The ranges are okay. So I think we go up into the sort of swing high around 6,500 or so. I can't really see the number, 6,900. I think we go and test those levels, but I'd be looking to cover shorts at the moment. I think the market's been doing that, and I think stay long healthcare, financials, small caps, and also probably have some exposure towards AI and tech. But Alphabet's really dominating, and buying pullbacks in that one there. So I do see the skew of risk higher in the S&P here.
All right. Well, then you gotta be selective if you're trading the S&P, like Westy says. And if you dig a little bit deeper, make sure you're real selective about what sectors you're looking at. I think that's the key
I want to
takeaway.
say as well, I think it's a really important point, is that the volatility has come down. A lot of people last week were buying downside puts. Demand for put protection had ramped up. We saw the VIX up at 28%. That's now 18%. So obviously, implied volatility in those strikes that weight up to the VIX has come down. You saw massive buying of out of the money puts as well, deep out the money. 10 delta puts, 1 month S&P were trading at a 13 vol premium to at the money vol, which is very, very very rare that you see that sort of premium. So what we saw last week going into those lows was a massive bid for downside protection. People hate buying volatility; it costs money, and there is no market that's more mean reverting than the volatility channels. But I think so many people are hedged in the vol channels that whatever the reason is that shorts have covered and people have cut back on those protections, and I think that's helped push the market up here.
Yeah, it sure has. Okay, well, let me turn your attention to where I'm having a little bit of hesitation about the market. As I mentioned, Bitcoin, which had led the market lower as it pushed into that support that Chris was just pointing out from where we got the bounce from this week. Bitcoin has failed to really see any type of bounce. And when you get such a steep sell-off, I love reading price action. Price action to me tells me a lot about the market. Just
it's the only fundamental you need, brother.
Yeah, when you get a sell-off like this and you see a real shallow bounce, that just tells you that no one's really looking at Bitcoin as being a value play right now. And so what that ends up setting up, and the way you translate that into prices, that ends up looking like a continuation pattern, which is what we're seeing here. It's either a bearish flag or a bearish pennant. So while we trade below 92, let's just call it 93,000, just to round it out, I think you got to be looking at it with a very skeptical eye. Now, what you'll also notice is this ascending trend line that we broke through. That trend line has actually had us contained into this uptrend since middle of last year. So while we trade below 93,000 and trade below that trend line, I think the risk is still lower. So be careful, because if Bitcoin turns lower and you're trading, let's say, the S&P on the long side, if Bitcoin starts to turn lower, remember that was the leader on the way down the last time around. It could tell you that maybe the bounce and risk is over as well.
All right, cool. Well, I want to bring up sterling against the Swiss franc. Why? Because I think the pound's very much in focus ahead of the budget, which is coming out today in the UK, and everyone's focused on whether this is going to lead to fiscal political instability and major personnel potentially losing their roles. But the pound is rallying very nicely into the budget. So people who've been short, I think, have been caught very much offside, and you can see the setup there. I think it looks great, and it's up 8 days in a row. So I was scanning on TradingView for all markets, all our spread-based markets that have seen price persistence, and this was the strongest one. So up 8 days in a row. We've broken the downtrend, and we're just looking to ominously push above that horizontal resistance level. So maybe that you could argue that's a sort of a loose inverted head and shoulder pattern, but I think this is an interesting one because, one, we've got the budget coming out. We've got Bank of England pricing for Bank of England cuts on the 18th of December at 88% probability. So, I think a large amount of that is those cuts are priced in, but yet the pound still rallied. Obviously, there's a Swiss element of this as well, and people are expecting rate cuts to permutate from Switzerland. But I think, if you want any market of any financial instrument which is seeing price persistence and consecutive form, sterling against the Swissy is the one, and I like the setup. It needs work. It needs to break and close above that horizontal resistance level. But obviously, with the budget's a big volatility event in the making in the session ahead. We'll see if Rachel Reeves can win the respect of the market, and obviously, we'll have to watch the gilt market, especially at the long end. If you see a very big outsized sell-off coming through, you'd expect the pound to sell off because she probably lost a bit of credibility from the markets. But the pound is rallying into this, so that people are expecting this to be a fairly pound-friendly outcome. So one to watch, but I like the setup very much so.
All right. Well, and another element that you have in that move, Chris, is something that I'll be talking about in a little bit. So make sure you guys stick around for that. Is the war in Ukraine and the peace talks that are happening right now, which could have a very negative impact on the Swiss franc if things continue to look more optimistic. So that's something else to be thinking about. Yeah. All right. Last for me is going to be the EURCAD. Now, I want to. This chart is a really interesting chart because I wish I would have been able to give you like 3 different charts here. If you go out to like a weekly chart and you look at the highs that we just broke and we're consolidating above, that goes all the way back to March of 2018. That's that blue line that you see under there. What you also notice is we have a triangle consolidation and we're consolidating above the breakout point. And now we're starting to peek our head above that breakout point today, at which does suggest that there's going to be further Canadian weakness. Now, the EURCAD to me is a really good a trading vehicle, especially if you see a massive amount of risk on or you see a massive amount of risk off. If we see a little bit of risk aversion, this one tends to go a little bit higher, and we are, even though we've had this nice bounce, the Euro Canadian has not given up anything. And so I think it looks like it's poised to ready to break out to the upside. Now, the flip side, and the reason why I put it as a setup is because if we break back below that blue line, that means we're breaking back down below levels that we broke out of in April of 2018. Anyway, we get back below that blue line, then you end up having a false breakout. You can trade it on the short side, but right now it looks like it's set up for a long trade. So I like it.
Good man. I've always found the EuroCAD's a nice one because it's just got a really nice mix of slightly higher volatility than euro dollar. Spreads are cheap. And
Yep.
it has a good propensity to trend when it wants to, and I like that. So good setup. Thank you for bringing that to attention. Let's go to play of the day. I've got a couple of interesting ones for you. I want to bring up Softbank, not because I actually want to trade it. If I did, I would be looking to sell rallies. I think this is a short seller's dream at the moment. I think a lot of people have been shorting it. But I want to bring this up because it is probably the most leveraged play on OpenAI. And as I said, if you're looking for concerns around funding and what's happening in the AI scene, potential bubbles, then I think OpenAI is arguably where everyone's focused at the moment. They've got huge amounts of funding needs that need to go through. They haven't even tapped the debt markets. But SoftBank, for me, is the most leveraged play. I know a lot of people are focused on Oracle, but Oracle have been issuing debt to help fund its investments into OpenAI. SoftBank have actually taken a very alternative route. What they've done is they've sold so many of their shares that they hold. Well, they sold 40.2 million T-Mobile shares. They sold their stake in Nvidia. I think 32 million shares of Nvidia. They sold a settlement of collar transactions using Deutsche Telekom, and basically they've raised $18 billion. They need to find, I think, another $11.5 billion potentially through a credit facility they've got on their ARM holdings. To fund their next tranche. They already funded 30 billion, I think, last year, and they've made some money out of it. But they've got another 40 billion funding to come through by the end of the year. But they've been selling out equity, and they haven't been raising debt. They've got a lot of debt, which is actually coming due next year, which could put some stress on their credit markets and credit default swaps. But if you want to see a bank which, if they do go in and do this 40 billion second tranche of investment, effectively, given their cash is tied up in other assets and other factors, is at the moment they will be putting their balance sheet and they're putting the house on OpenAI. So there's a lot of risk with this strategy, and given that they've got so much debt to roll over next year, I think this is one that really is probably going to be the poster child of OpenAI. And as you can see, it's fallen significantly, 45% from its highs. So if you want to see a stock which is most leveraged to OpenAI, it's not necessarily Oracle or CoreWeave. It's to me, it's SoftBank because of their huge investments that they've made and will continue to make over 2026 as well. So, I think the fact that it's falling so sharply is something that is a bit of a concern. And it's also allowed people to ask the question, is there systemic issues? Will OpenAI have to be backstopped by the US government at some stage? So this is definitely one that people are probably hedging themselves. Go long Nvidia, stay long Google, all these kind of names, and short the SoftBank as a hedge effectively against that situation. So one to watch. It's not one that necessarily people trade or own, but I think it's a brilliant proxy of how people are seeing OpenAI.
Whew, that's a scary looking chart, Chris.
Yeah.
Thank you for actually that explainer and bringing it to all of our attention.
Well, the interesting thing as well is that everyone's focused on credit default swaps. So I haven't focused on credit default swaps since 2011, 2012, where people were selling out of, people were getting set, hedge funds were getting set in short euro positions and then smashing Greek CDS or whatever because they were far more illiquid and they could move them. And the CDS were blowing out and that was pushing out, causing big gyrations in the bond market, and euro would then fall. So you could affect the euro. So I haven't really focused on those, but if you look at credit default swaps on SoftBank, they're actually not at alarming levels. They're trading at 288 at the moment, which the math checks out that the market's saying there's about a 20% chance of credit default in the bond in their corporate issuance over the next 5 years, which is not massive. Oracle's had a bigger move, but I think if the credit default swap started to really flash red and show that there's a credit event on the horizon, then the equity is just going to get smashed. So one to watch.
Yeah, definitely. I actually just added it to my watch list as you've been speaking. Okay, thank you very much, Chris. I appreciate that. Actually, I don't even want to go now. So, okay, I got it. All right. So we are going to be praying for peace with the Euro Swiss. And you remember, Chris, like several months ago, I brought up this chart and I had like Gartleys and butterflies, and I'm like, it's so sexy, and you're like, that's the sexiest chart. It ended up being like the furthest thing from sexy. It was a nothing burger. We just skated across the bottom. Nothing happened. I tried to play it on the long side. Nothing happened. I'm like, screw it. Left it alone. Actually, 2 weeks ago, we broke that low and we created a false breakout. Now we have reversed higher. We're almost at the 200 DMA and the 38% retracement. And if we get a breakout to the upside, Chris, and that's only going to happen as, Russia and Ukraine put together a peace deal, even if it's just short term, even if it's just for both fighters to go back to their corners, rest up, rebuild their armies, blah blah blah, before and sit out the winter time because it's too cold over there before they re-engage in the spring. Even if it's just that, the Euro Swiss probably has a rally behind it. Now, it broke down. It broke down back in February of 2022. You know what happened in February 2022? That's when Russia invaded Ukraine.
That's right. Yeah.
Yeah, and it broke down below like really critical support in February 2002. Go back and check it. I'm not showing it on this chart. So if things do get better and we pray for peace, the Euro Swiss is probably going above that 200 DMA, and we're going to backtrack some of these gains that we've seen in the Swiss franc as things get better in that situation.
I think it's as well. I mean, if you immediately my trader mind and connections go into overdrive when we talk about peace. And from a humanitarian perspective, obviously we hope that's going to be the case. But from a markets perspective, where you remove any kind of sensitivity to that, I think nat gas and crude would rally pretty strongly if we actually got a formal announcement. And obviously it depends what that looks like and whether we trust it. And whether it's going to be sticking and lasting. And I'd imagine Brent crude and nat gas would fly on that node. So yeah, that's certainly something to watch.
Absolutely. And I'm like you, Chris. I try to segregate the two. Like, we trade the markets to make money. You don't necessarily want to make money as things are happening that are just non-humanitarian situations. But this would be something good. This would be positive. So let's hope. Let's pray for peace.
Pray for peace, absolutely. Okay, cool. Us traders do have a heart, and we are not robots, and we think like that. Anyway, good. Thank you, everyone. I think we're coming into the business end of the year, and I think Blake and I will be discussing some of the big thematics that we're looking at for 2026 in an upcoming episode. And we're starting to have some strong views about what are going to be the major drivers and the major macro thematics that we should all stick around for, and which will drive correlations within asset classes. So something that we're doing our homework on now, and so I think that's going to be a really exciting episode to share with you guys at home. So do stick around, and thank you for watching today. Hit like and subscribe if you fancy it. We appreciate that, and we'll see you back next week for more of the trade-off.